but we support too big to fail. We want the government to be able to take down a big bank like J.P. Morgan, and it can be done. We think Dodd-Frank, which we supported parts of, gave the FDIC the authority to take down a big bank. And when it happens, I believe compensation should be clawed back, the board should be fired, the equity should be wiped out, and the bank should be dismantled, and the name should be buried.
That's J.P. Morgan Chase Chief Jamie Dimon speaking yesterday morning on Meet the Press, even as heads look set to roll in the bank's trading mess and the debate over too big to fail banks reignites. Good morning and welcome to the Wall Street Journal's News Hub. I'm David Riley. Well, we've got a busy Monday morning for you. We're going to be talking about Yahoo and the changes at the top there and going for the latest read of the economic tea leaves. But first, let's jump right into J.P. Morgan and what's happening there, the latest. I've got the Journal Blogging Supremo, David Benoit here, and we've got Chris Whalen from Institutional Risk Analytics and noted bank analyst. Good morning and thanks for joining us. All right, Dave, why don't you tell us the latest over the weekend, what's happening, and it looks like we're going to start seeing some firings at J.P. Morgan.
Yeah, there's definitely going to be a couple people on their way out, it seems like. So Ina Drew, who is the chief investment officer, she's in charge of the whole unit where this trade went on, is expected to resign as soon as today.
And she's the person who is in charge of the office where these trades took place.
Yes. So she's in New York. The trades were in London, as we learned, and she is in charge of all of this. And she's supposed to be, risk manager. She's had a 30-year career as being noted as a very good trader and a risk manager inside the bank, and now she seems to be taking the fall for this one.
And this is coming. The departures are likely, it seems, to be announced sometime either today or tomorrow before J.P. Morgan has its annual meeting.
Yeah, exactly. So that's what they're facing tomorrow. Jamie Dimon was already facing a little bit of pressure from some unions and groups to split his CEO and chairman title, and certainly this is going to add to the fire there and on pay.
Chris, how much fireworks do you think we're going to see tomorrow at this annual meeting down in Tampa?
Well, you'll see a lot of fireworks, but much ado about nothing. We have indirect democracy in our corporate world in the U.S. And, the officers and directors ultimately have a duty to the corporation, not to shareholders. Everybody forgets this. Right. We were firing people in the office of the chief investment officer at J.P. Morgan 6 months ago because of the implementation of the Volcker Rule. And the question I have is, did the regulators help screw this up? In other words,
how so?
Well, very significant parts of the team are already gone. The whale and this lady who's been acting as chief investment officer are basically the last of the Mohicans because the whole unit was being dismantled because of the Volcker Rule. So I wonder at some of the odd things. And also, are we going to discipline the Fed? Are the examiners who blessed the VAR model that was used in this risk-taking going to be held accountable too? If we're going to fire the bankers, shouldn't we fire the regulators if they're doing their job? So I think there'll be a lot of hemming and hawing about this, but keep in mind, I think this part of the bank overall was still profitable.
Right, it was making money, but I guess the question is, how much did it make versus a $14 billion stock market loss Friday?
$2 billion is lunch money at J.P. Morgan. I mean, come on, guys.
No, true, but $14 billion on the market on Friday, that's not. Even that makes Jamie Dimon wake up in the morning.
Look, I don't look at valuation based on one day. No banker does.
Sure.
As you know, I'm at Tangent Capital Partners now, and I've been working on a hedge fund product. And we're basically doing very similar things to what Morgan should have been doing, mostly long, with a little bit of tactical trading on top. I think here they started getting too creative and a little bit too much innovation, as you know what we mean. What I mean. But I think, to me, there's a lot of yelling and screaming about this. But I think when you step back and look, this was already changing. This function was going to be gone.
Let me ask you, though, now I was writing, not to plug my own piece, but I was writing this morning in the Heard in the Street column about how this is going to be really, it's not just paying for J.P. Morgan, Morgan Stanley and Goldman Sachs are going to bear a lot of the brunt of this.
I thought that was very well taken. And look, remember, Morgan Stanley, Goldman Sachs are financed by a bank. Right. Even though they're broker-dealers, even though they are technically bank holding companies, they really don't have the kind of core funding that made J.P. Morgan the fortress. So I think all of these institutions are going to be under a lot of pressure because of business model, because of regulatory issues. But as I often argue,
regulatory. David, how bad do you think the blowback in D.C. gets?
So it certainly sounds like this is going to be pretty hard for them. Certainly Senator Levin's been out pounding them. Jamie said again yesterday on Meet the Press, this is unfortunate timing in terms of.
There's an understatement from a normally blunt spoken.
Come on, so what? Look, I think the Congress will try and make a lot of it, but at the end of the day, these banks need to take less risk and less stupid risk. They don't need more capital. I argue with Sheila Bair about this all the time. She says, "But Chris, don't you think we need more capital?" I said, "No, we simply need to really, I think, take a step back." If you think of it, if Morgan had just owned their long position and not had this aggressive trading strategy around it, they would have earned what they earned. And they would have had the market to market. That's kind of the classical model.
Right.
In other words, you don't own it if you don't like the credit. This notion of hedging and tactical trading around positions, you got to look at very carefully, because some strategies make sense and some do not. And I think this, unfortunately, was a case where they didn't understand the correlations they were working with, and it went against them.
I think that's in some ways the scariest thing to a lot of people, because everyone looked and said, well, if anybody's going to get it, it's Jamie Dimon and JP Morgan.
But these are over-the-counter markets and they're illiquid. That's the problem. There's no price discovery, so you may not know what the basis is.
Right. Okay, last question for you guys. The debate over too big to fail, it's inflamed again right now. Do you think that this sort of flares and then dies down, or do we reopen legislatively on this?
I don't see this necessarily reopening legislation. I think it's a major hiccup for this bank, and certainly raises a lot of questions, but I'm not sure it necessarily gets its size in a way that people.
Well, I'll tell you this. You don't need more authority. We have plenty of resolution authority now. But that clip with Jamie Dimon on Meet the Press, where he describes what should happen to a big bank that messes up, that's about all we needed. We just point to that. That's our source.
Chris, last word to you. Does Jamie Dimon survive this?
I think he does in the short term, but they need to look at succession anyway. All banks do. This whole issue of bifurcation of the chairmanship and the CEO, I think, should be the rule for large public companies, because the chairman runs the board, the CEO works for the board. I don't even like to see CEOs sitting on the board.
All right, David, Chris, thank you very much for that, both of you.